Welcome to another accounting video, and today AQA ACCN2, June 2014. I'm just doing question 1 today. So we're given Mo, who is a sole trader, and essentially what he does is just buy and sell goods. And we're told to do a cash budget or a cash flow forecast, whatever you want to call it, for the 3 months, July, August, September. So this is going to be a lot of things about inflows, outflows, knowing the difference between when a good is sold and when the cash is received from that sale. It's similar to saying what's the difference between profit and cash, isn't it? There's two different things. So what I've already done is, and you've just noticed with the paper I've just put away, I've already laid out the spine of my workings and the spine of my answer just to save you guys time. So if you want to print the paper off, that might be advisable, because I know the text is small here and I don't want you just to zoom in the video and make it all blurry. But the first point is about sales on credit. So it is expected that 40% of customers will take advantage of the cash discount of 2.5% that Mo offers and will pay in the month of sale. So 40% of July sales will pay in July, and they'll be given a 2.5% discount for paying in cash in the month of sale. It's as simple as that. Of the remaining 60%, because we've done 100% minus 40%, it is expected that half will pay in the month after sale and the remainder will pay 2 months after sale. So half of 60% is 30%, so 30% of July sales will pay in August and 30% of July sales will pay in September. It's as simple as that, really. So what I've laid out here is sales. So you can just ignore this bullet point for now. We're just going to do sales first. So I've laid it out in the months, July, August, September. And I've laid out the 3 different ways that people are paying. They're paying on cash, they're paying after 1 month of credit, and they're paying after 2 months of credit. So what cash payments are we receiving in July? Well, it's going to be the sales we've made in July, isn't it? So 18,000 times by what percentage? Well, 40%, so 0.4 times by, well, they're getting a 2.5% discount, aren't they? So we're not getting this full amount, are we? We're getting 0.975. So that's just 100% minus 2.5%. That's all that is. So 7020. So that's after the discount. We don't need to worry about it anymore. So what cash are we receiving from 1 month's credit sales? Well, the month before July is June, so these sales will be given 1 month credit into July, won't they? So what we'll do is 15,000 times by half of this 60%. So I'm just going to times it by 0.3. So 15,000 times by 0.3, £4,500. And very similar with the 2 month. It's just 2 months before July. So £12,000 times by 0.3 equals 3,600. So the total cash inflow from sales in July is 15,120. So it's the same story for the rest of the months, so we'll just go through them anyway. So August cash sales, I'm just going to pick out the August sales value, 15,000, times it by the percentage paying in that way, 40%, and take off that little cash discount, 0.975, gives us 5,850. 1 month credit, what's the month before August? It's July. July sales are £18,000. £18,000 times by the 30% gives us £5,400. 2 months before August, June. You can probably tell now it's getting pretty repetitive, and it's just knowing the basics and just going through it step by step. As long as you stick to the method and don't deviate from it, you can't really get this wrong, can you? 15,750. And the final month, September, the sales in September are 12,000. 40% will pay in September. Take away a bit because of the cash discount they are given, 4,680. Month before September is August. August is sales of 15,000. 30% pay with 1 month's credit, which gives us 4,500. And we probably can guess it by now. It's very simple. 18,000 times by 0.3, £5,400. Gives me a total of 14,580. So it was important to do them because we need them for the drawings later, which I'll get onto later anyway. So we're on to purchases. So one supplier of most purchases of goods for resale, so his purchases, demands that he pays cash immediately. So when he buys the goods, he has to pay immediately. He doesn't get any credit. This supplier accounts for 10% of purchases. The other suppliers are paid 1 month after the purchase has taken place. So what I've laid out here, I've laid out the 3 months that we're analysing, July, August, September. And I've laid out the 2 ways that Mo pays his suppliers. He pays 10% cash and he pays 90% 1 month credit. And there's no discount or anything associated to these, so it should be quite simple. So in July, Mo brought in £8,000 worth of goods, and of that £8,000, 10% were paid by cash, £800. So it's just the same as sales, 1 month credit, so he's buying goods in June and paying in July. So the goods came in June, but the cash outflow is in July. So we account for that cash outflow in July, don't we? So we're just doing £7,000 times by that 90% that give us 1 month credit, £6,300. Just add them together, £7,100. And it's just the same story with August and September essentially. So purchases in August were 8,500. 10% want us to pay by cash, 850. The purchases in July were £8,000. 90% give us credit. That gives me 7,200. Add them together, 8,050. And finally, September. Purchases in September were £9,000. 900 in cash, 1 month's credit. Well, August's purchase 8,500 times by 0.9 gives me 7,650. So total cash outflow from purchases in September were 8,550. So we've got the bulk of our inflows and outflows now. So I've got some more workings just to get through, and then we'll actually be able to put it all into our actual answer. So, overheads. Overheads are paid in the month they are incurred. So essentially, overheads incurred in July, we pay in July. It's as simple as that. So it's basically just copying the figures into your workings. An NCA purchase. So Mo intends to pay for non-current assets costing $10,800 in September 2014. So it doesn't matter. It says when he pays for it. We don't care when he acquires it. It's just when we pay for it, because we're dealing with cash, aren't we? So it's just £10,800. Simple as that. So you'll notice that these 3 are all outflows. The only inflow we have is sales. It's very simple. So Mo will take cash drawings from the business equal to 10% of the total cash received that month. So I just said the only cash we're receiving is from sales, so it's quite easy to calculate this. However, this will never be less than 1,500. So it's going to be our sales times by 10% gives us our drawing figure, and if it's less than 1,500, we just increase it to 1,500 regardless of what the original value was. So let's use our previous workings. So July, 15,120 was the inflow, times by 10%, 0.1, 15,120. 15,750 was August. And finally September, 14,580 times by 10% gives me 14,580. and you'll notice now that is less than 1500. So our actual drawings figure will be 1500, and that is your workings. Your sales, you're on the inflow, and you've got 4 outflows: purchases, overheads, the purchase of a non-current asset, and drawings. As simple as that. So with that in mind, I'll put the question. Oh, I can put the question paper away for a little bit, but we'll need it when we come to the end of July's cash flows for a reason, and I'll bring it back. So what were July's sales? Well, 15,120. So the only inflow was 15,120. Purchases in July were 7,100. Overheads 7,100 as well. And it's as simple as this. It's just copying it down from your workings. Drawings in July were 1,512 £, and we only have the NCA purchase in September, so we'll just put a line through there. So our total outflows in July, 15,712, bigger than our sales. So I'll bring the question paper back now. Mo expects his bank balance to be 6860 on the 30th of June 2014. So on the 1st of July, it's the same figure, is what we assume. 6860 is his opening balance. The net cash flow for the month is negative 592 because our outflows exceed our inflows. So our closing balance will go down from our opening to 6268. And we'll carry this across to our opening for August. 6268. So once again, it's just a case of just copying it back in. What were our sales in August? 15,750. Purchases 8,050, so they've gone up. Our overheads have gone up as well, 7,500. And because of our increased sales, our drawings have gone up. They're linked, aren't they? The bigger the sales, the bigger the drawings, because of that 10% thing. So total outflows for August was 17,125. So once again, you've noticed that outflows is bigger than inflows by an even bigger amount of 1375. So there is no written question or narrative question after this. Sometimes we'll get asked to advise Mo on the cash flow situation. What you notice in here is his net cash flow is actually getting worse. So what would you advise Mo? Just think that through sometimes, because it may come up. So finally, we'll just carry that closing balance across. 4893. Okay, so sales in September, 14,580. The only inflow, so our total inflows are 14,580 for September. Purchases in September, 8,550. Overheads, 8,240. And the drawings, we had to round up, didn't we, to 1,500 because they fell below. And the NCA purchase, we're finally making use of £10,800. Obviously this is going to have a big impact on the net cash flow, isn't it? Negative 29,090. So net cash flow for this month is 14,510 negative, going into a closing balance of 9,617. So you could consider, if there was a narrative question for this, does Mo have an overdraft facility? He's negative. And that's it really. There's my workings, there's my answer. If you've got any issues, please email me, and I'm happy to answer any questions, and I'll see you in the next video.